Open higher midway trade after steadying on Tuesday. The S&P 500 gained about 1% a day after the unraveling of crowded trades, and economic jitters drove the index to its biggest drop since 2022 earlier this week. Now, when we consider some of Monday's laggards, Nvidia and Robinhood markets, they did claw back some of its losses, but not enough to get back into positive territory for the week. This morning, I am joined by Ed Siddell, the president and CIO of EGSI Financial. So, Ed, thank you so much for joining me today. It's been quite the volatile week. Global markets sold off on Monday with the Dow sliding over 1,000 points. But today, we're seeing the major averages trying to recover some of the losses. So, tell me about what we saw over the last several days, including the big drop on Monday.
Absolutely. Well, first of all, thanks for having me. And we've been expecting a pullback to the point of even a correction before the end of the year, actually before the election. And so, this was expected, but, I think what we saw was a lot of profit taking and then some panic sell off. I think it was a little bit of a pile on because of the yen and the carry trade. But what we're seeing now is the recovery because the everyone's looking at the Feds and what they're going to do. I think everyone is now anticipating the Feds are going to lower rates more than originally anticipated. We expect them to lower rates, 1% because Powell is really looking for a soft landing, and this is his legacy. So we don't see an emergency rate cut. But we do see, in September, as much as a 50 basis point lowering of the rate.
And Ed, it was interesting because on Monday morning, even before the market opened, we were hearing rumors or potential murmurs about whether or not the Fed would be cutting rates in an emergency move. But when we look at market action from profit taking and then panic, the unwinding of crowded trades as well as low liquidity meant lots of volatility. And we saw that as people try to exit trades, including long Mag 7 or even the carry trade for the yen. So does the unwinding have more to go in terms of market action?
Yeah, the volatility is not over yet. I think we're going to see some more yo-yo effect between now and the election. But as soon as the Feds confirm that they're going to lower rates, we're going to start to see a rally. You hate to politicize, the economy and the rate cut, but this is the Feds have been so reactionary from transitory inflation to letting inflation get out of hand, and then cutting rates and now we're going back to some sort of quantitative easing. So, I think they're going to lower rates, and that's going to create the soft landing that investors are really looking for. But I think the up and down swing, it's not over yet.
And it's very interesting because when we look at the U.S. economy in terms of the latest data releases, whether we're talking about non-farm payrolls or the unemployment rate, it isn't that shocking or that staggering. And when we're looking at the GDP, we just saw that come in above 2.5%. But when it comes to rate differentials and what we heard from the Bank of Japan, what do you make of that?
What everyone is looking at right now globally is they're looking at the U.S. The EU has already cut rates. The Japan, the yen, when they raised rates, I mean they've kept it at the current rate for over 15 years. And as soon as they saw the panic that hit the global markets, including the U.S. markets, they actually announced overnight that they're going to keep rates where they are. They're not going to raise them any further. So, that has stabilized markets. When we're looking at, inflation and recession right now, from the United States, I mean, it really is a tale of two cities. Everyone says we're not in a recession. But when you look at Main Street versus Wall Street, on Main Street, you've got the working poor and the middle class that are becoming the working poor. You've got more loans taken out of 401ks and over the last 10 years, actually since 2008 and 2009. So Main Street is struggling right now. And even if the market does recover, we're still seeing a slowdown in the economy. So the markets are going to help, but it's we're going to need a change in economic policy in order for the U.S. to continue to grow.
And Ed, we have about 60 seconds here, so very quickly, as you mentioned, markets are still up for the year, even if they've fallen from what we've seen weeks ago. But where are the opportunities right now in the market?
I think there are a lot of opportunities. If you're invested, we told all of our clients on Monday, now is not a time to panic. Now is a time for cooler heads because they will prevail. If you have cash sitting on the sidelines, there's some great values out there. There's still a lot of companies, in the tech sector, AI, that have very, very strong balance sheets as well as other sectors. So, making sure that you have a well-diversified portfolio and you're looking for those good buys is going to be really important. But the reality is, if you're at the end of the runway, you're at or in retirement, you want to make sure that you have a diversified portfolio, especially as rates lower, that's going to really increase the bond market. So making sure that your portfolio is diversified is going to be key to success.
Okay, Ed, well, thank you so much for weighing in on the markets and also giving us your perspective on what we're also seeing on Main Street.
Absolutely. Thank you for having me. I appreciate it.